Hey everyone, we had some massive news come out of ChargePoint in the middle of October. Two big pieces of news that came out of ChargePoint specifically. So in this video, I'm going to go over those two big news items. I'm going to connect it to the company's financial statement or financial metrics and how it's going to connect and how it's going to impact their financial metrics. I'm also going to look at the company's stock price and its valuation and tell investors what I think about this recent development and what it could mean for ChargePoint stock investors and whether it makes the stock more attractive, less attractive, if you should buy this on the dip, or what you should possibly do. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with the news item with ChargePoint ramping up production of Tesla compatible NACS EV chargers. The company saying that it's now rolling out the NACS connector support for its AC and DC charging solutions, with much of the lineup to be delivered over the coming month. Cable conversion kits will go out to customers in November, and this will offer Tesla drivers a public fast charging alternative for the first time. Now, with more than 35 million historical ChargePoint sessions initiated by Tesla vehicles, Tesla car owners are one of the primary customers for ChargePoint. You might be surprised to hear about that. You might think Tesla car owners only use Tesla charging stations, and that's not true. Tesla car owners charge their vehicles at a multitude of charging stations, and ChargePoint is one of the companies that benefits from Tesla car owners the most. In fact, in the most recent conference call, ChargePoint management went through great lengths to say that Tesla car owners are one of their favorite customers. They're one of their most valuable customers. So this move is compatible to their customer base. It fits the needs of their customers, which are Tesla customers, and Tesla customers have the option of going to Tesla supercharger stations to get faster charging. And so now ChargePoint is rolling out its own faster charging, thereby hoping to attract more of those Tesla car owners to come to their charging stations and fill up and charge over with them. So keep this in mind. I'm going to connect how this is going to impact the company's revenue in a little bit. So the next piece of news came out from ChargePoint, and that was related to capital, to money. The company's losing a ton of money on the bottom line, which I will share with you in a little bit. And so they need to continue raising money to fund their operations, to fund their growth. So ChargePoint announced a 175 million common stock issuance pursuant to the company's at-the-money offering facility. Separately, ChargePoint raised net proceeds of 57 million in additional funds under the existing at-the-money facility ending in 2024. All in all, the company raised an additional $232 million of cash in the quarter. Now, keep that in mind when we go back and look at the company's cash balances and how that's going to impact the company longer term, how it's going to give it more of a runway. Additionally, ChargePoint and the lead investor in one of their notes, in one of their bonds, entered into an agreement to adjust and modify the existing bonds. And that agreement would give ChargePoint one extra year to pay back the principal on those bonds. So those notes, that principal was due to be paid back on April 1st, 2027. ChargePoint negotiated an extra year to pay back. So now they have until April 1st, 2028. So one extra year to pay back. However, ChargePoint had to pay a king's ransom for that extra year. In my opinion, they gave up too much for this extra year, but it may have been out of necessity. So now they're increasing the cash coupon on those bonds from 3.5% to 7% per year, doubling the interest expense, and increasing the payment in kind coupon from 5% to 8.5% per year. The difference between a cash coupon and payment in kind coupon. Let me discuss that a little bit. So ChargePoint's lenders say if you pay us in cash, we will accept 7% per year. However, if you're going to pay us not in cash, for instance, if you want to pay us in stock instead of cash, then your interest goes up to 8.5% instead of 7%. So if you choose not to pay us in cash, sure, we'll take a different form of payment, but we're going to charge you more for that, and that's going to come to 8.5%. Also, ChargePoint adjusted the conversion price from $24 per share down to $12 per share, making it more likely that a conversion happens, which will dilute existing shareholders. So all in all, ChargePoint had to give up a lot in order to get just one extra year to pay back this principal, but it might have been necessary because ChargePoint was looking at its prospects and saying, it's not likely we're going to have this money to pay you back in the year 2027. So let's get an extra year to pay you back. And we're willing to give up more to get that extra year. But overall, this change was not good for ChargePoint stock investors because it required ChargePoint to increase the interest expense, give up better terms to the lender in order to secure that extra year to pay back. And that was reflected in ChargePoint's stock price. You can see ChargePoint stock is down significantly on the year, and most recently it's been falling precipitously. It's down to $2.95 per share. That's down from the close to $40 per share it was trading for at its highs. So ChargePoint stock price is down significantly. Now, the company is growing revenue rapidly. I mean, you look at this revenue growth rate from less than 40 million in July of 2020 up to 150 million in the most recent quarter. But revenue growth on its own is no reason to invest in a company. It's easy to grow revenue if you're willing to absorb losses on the bottom line. I can go and make a product that costs me $200 to make and sell that product for $5, and I would have a line of customers wanting to buy my product. I'm creating something that has a value of 200, selling it for 5. Of course I'm going to have a lot of customers. Am I going to have a good business? No. I'm going to lose a ton of money, but I'm going to have a lot of customers. I'm going to have growth. So, but what's the point? That's not the reason you want to be in business. You want to be in business to generate profit, to generate cash flow, and that's not what happening at ChargePoint. 150 million in revenue in the most recent quarter, but they lost 123 million in operating income. They lost 123 million in operating income, and their losses are just worsening as they're growing revenue. So they're generating more sales, but that's just leading to more losses on the bottom line. They are generating some economies in scale in that the operating profit margin, the negativeness of the operating profit margin is improving, although only slightly, only moderately compared to the losses on the bottom line. So that's leading to a lot of cash going out of the company. In the most recent quarter, 86 million. And you can see negative cash flow from operations in nearly every single quarter the company has operated, and it's just getting worse. It's just getting worse. That's why the company needed to go out and raise more money, raise more capital, sell more stock, and dilute shareholders even more. And you can see the average diluted shares outstanding have increased from a little over 250 million all the way up to 355 million. This means when or if the company becomes profitable, it's going to need to share those profits among more shares, thereby decreasing the earnings per share. So each shareholder or each owner of a share is going to get fewer profits because there's more shares outstanding. They need to split the proceeds with more shares. That's not good news for investors either. And then if you look at its cash and compare it to its debt, that's not looking good either. You've got 295 million in long-term debt compared to 233 million in cash and equivalents. And remember, I showed you earlier, the company was losing 123 million on the bottom line, and 86 million of cash from operations was leaving the company every quarter. So that 233 million is not going to last very long when you're burning 86 million every quarter. And so you could see again why the company needed to go out and raise more capital, and also why it needed to extend the due date of that debt, because how is the company going to have that money to repay that bondholder when it's losing money every quarter? Sure, management says they expect to be adjusted EBITDA profitable by the fourth quarter of 2024, but that doesn't necessarily mean they're going to hit that target, and that doesn't necessarily mean they're going to be cash flow positive. Again, raising concerns about capital, about money. Finally, yes, ChargePoint stock price is down significantly, not only the actual stock price, but also valuation. What I have here is the forward price to sales ratio. The company used to trade at a forward price to sales closer to 20, and now it's trading at a forward price to sales of just 1.212, the lowest price it has traded for in its history. And you might say, well, that's a bargain, that's a buying opportunity, I should jump in. And I would say, hold on a minute, wait a second here. Do you really want to go in and buy a share of a company that's losing so much money on the bottom line, that hasn't proven it can operate the business effectively, where it generates profits, where it generates cash flow? Yeah, the share price is down, but I would argue the share price should have never been as high as it was. Remember, in 2020 and 2021, there was way too much investor enthusiasm for these EV related stocks. Anything related to electric vehicles was flying to the moon for all the hype and the enthusiasm, because they were saying it's a massive market opportunity. And yes, it is a massive market opportunity. The market is growing. There's significant government incentives to increase the market. But that doesn't mean that a business that's growing is also going to be profitable. There's a difference between growth in sales and growth in profits. As an investor, growth in profits is my priority, not growth in sales. Like I mentioned, it's easy to grow sales if you're willing to sell your product at a price low enough that is attractive to customers, but you're losing a lot of money on the bottom line. And so for all those reasons, I would say, hold off on buying ChargePoint stock just yet. Yes, the price is down, but there's a justifiable reason the price is down. The company's prospects are not very good. Growth prospects are excellent. Revenue prospects might be excellent, but in terms of generating those sales profitably, that hasn't been proven. I would wait to see more proof, right? There's no harm in waiting to see more proof. I would rather make the mistake of investing in a company too late rather than investing in a company too early. That's just my preference. So, massive news coming out of ChargePoint. Investors did not like the news. We discussed why, because it's not going to be positive for the company's profitability. It might be positive for the company's revenue, as they make it more attractive for Tesla car owners to use ChargePoint charging stations. But still, that doesn't necessarily mean it's going to boost the company's profits. But before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching.